Wednesday's move by the U.S. Federal Reserve Bank, hiking interest rates by 75 basis points, 0.75%, is an indication of the Fed's determination and an escalation of its war against inflation. As recently as last week, most market observers had expected only a half-point increase. And so this represents a last-minute change of strategy by the Fed. It should be noted that the Fed's move was in response to a startlingly high CPI report that has shown that for consumers in Chicagoland, for Chicago businesses, we're all facing an inflation problem that is shown to be more persistent than many had earlier expected. This was compounded by a PPI report on Monday that showed that wholesale inflation, while perhaps not as surprisingly higher, continues to be quite high. And again, this is a candidate to keeping price stability. Our view at Fifth Third remains unchanged in the sense that we believe the Fed's urgency is to get to a neutral interest rate, one they define as 2.4% Fed funds rates. And this escalation of the pace does not mean that the final Fed funds rate will be substantially higher. We think the Fed is very eager to control inflation expectations, and that the concern in the wake of the most recent CPI report is that inflation expectations will become unanchored, to use the Fed's terminology, and risk spiraling into an inflationary psychology. The Fed's determined to show that they will do what it takes to arrest this kind of inflation, and that this is a move that intends to get to neutral. But the Fed is also cognizant of its other mandate, promoting full employment. With over 6 million job seekers in the United States and an ample number of job openings, the Fed is not eager to risk a recession. So this is a very fine balancing act by our central bankers, containing inflation expectations by being very aggressive. At the same time, there is some reluctance to actually enter into tight monetary conditions that would provide a further risk of falling into a recession. Chicago business owners need to be paying attention to this shift from the Fed. We view the persistence of inflation, as evidenced by that CPI report, as creating a tougher act for the Fed in slowing the economy sufficiently to arrest inflationary forces without tipping the balance into a recession. To put some numbers on it, prior to the CPI report, we would have estimated the chances of a recession as roughly 30%. Today, we estimate those chances as closer to 40%. Because of the persistence of inflation means that the Fed may have to act more aggressively, hence this 75 basis point rate hike, or may have to stay on a tightening path for a longer period of time. In each case, the risk of recession goes up, although it is still not our base case at Fifth Third.